If you walk through the main commercial street of almost any major Western city today, you will immediately notice something that feels deeply wrong. Digital billboards, shop windows, and news tickers insist that everything is fine. Stock markets are hovering near record highs. Unemployment numbers look manageable. GDP figures suggest steady growth. On paper, the system appears healthy. But when you stop looking at the screens and start looking at the people, a very different reality reveals itself. Faces are tense, conversations are quiet and cautious. People hesitate before buying basic food, mentally calculating prices that have nearly doubled in just a few years. Storefronts sit empty, plastered with for lease signs that seem to multiply month after month. There's a heavy atmosphere, a shared, unspoken sense that, despite what officials claim, something underneath the surface is breaking. This disconnect between the official economy and the lived experience of ordinary people is not a coincidence, it is not bad luck, and it is not the result of a single crisis or shock. It is the visible symptom of a long-running structural failure that began nearly 2 decades ago and was deliberately concealed. What we are witnessing today is not simply a recession or a normal economic slowdown. It is the closing chapter of a specific economic era. For more than 15 years, the global economy has been kept alive through artificial means, fueled by cheap debt and massive money creation. That life support system is now being withdrawn, and the patient is finally being forced to confront reality. To understand why this moment feels so different, we need to ignore the usual explanations about supply chains, wars, or political cycles, and focus instead on the single most important price in the world, the price of money. For most of human history, money was not free. Borrowing capital came with a real cost. If you wanted to build a factory, start a business, or buy a home, you paid an interest rate that reflected risk. That interest rate acted like gravity. It forced discipline into the system. Only projects that could generate real profits survived. Companies that failed to earn enough to service their debt went bankrupt. Their assets were sold, reallocated, and put to better use. This process, painful as it was, allowed economies to evolve. It was the mechanism of creative destruction that kept capitalism anchored in reality. Everything changed after the global financial crisis of 2008. Terrified of a deflationary collapse, central banks across the world made an unprecedented decision. Interest rates were slashed to zero, and in some cases pushed below zero. What was supposed to be a temporary emergency measure became permanent policy. The zero interest rate era was born. For more than a decade, money was effectively free. Saving was punished. Risk-taking was rewarded, regardless of quality or productivity. This distortion reshaped the entire financial landscape. With no return available in traditional savings, trillions of dollars were pushed into risk assets. Real estate prices exploded, not because homes became inherently more valuable, but because mortgages became absurdly cheap. Stock markets drifted further and further away from corporate earnings. Speculative assets with little or no real-world utility reached staggering valuations. Everything inflated at once. The illusion of wealth spread everywhere, but it was built on cheap credit rather than real productivity. One of the most dangerous consequences of this environment was the rise of what economists call zombie companies. These are businesses that generate just enough cash to keep operating and pay the interest on their debt, but not enough to ever repay the principal. In a healthy system, such companies would fail. Their resources would be freed and redirected toward more productive uses. But in a world of near-zero interest rates, they never had to die. They could endlessly refinance their debt, rolling old loans into new ones at negligible cost. They became economic undead, absorbing labor, capital, and resources while contributing little to real growth. By the early 2020s, estimates suggested that roughly 1/5 of companies in the United States and Europe fit this definition. The system was stable only as long as interest rates remained near zero. The moment rates rose, the entire structure would be exposed. That moment arrived with the inflation shock. Years of aggressive money creation, accelerated during the pandemic, finally broke through. Energy prices surged, food costs climbed, housing became unaffordable for millions. Central banks, having lost control, were forced to act. Interest rates were raised at the fastest pace in decades. The transition was brutal. The era of free money ended almost overnight, but the massive debt accumulated during that era did not disappear. Instead, it remained embedded in balance sheets across the economy. This set the stage for what is now unfolding, the maturity wall. Trillions of dollars in corporate and commercial real estate debt, originally issued when interest rates were near zero, are now coming due. These loans must be refinanced, but instead of 2% interest, borrowers are facing rates 3 or 4 times higher. For many companies, the math simply doesn't work. A business that could barely survive under cheap credit becomes instantly insolvent under normal rates. The first cracks have already appeared, particularly in commercial real estate. Office buildings once valued at hundreds of millions of dollars are now selling for fractions of their former prices. In many cases, owners are simply walking away, handing the keys back to lenders because they can't afford refinancing. The wealth that appeared to be created over the last decade is being revealed as largely illusory, driven by inflated valuations rather than real income or productivity. As this process accelerates, the consequences spread outward. Banks that lent to these companies discover that their balance sheets are full of assets worth less than assumed. Pension funds that invested in real estate and leveraged assets face growing shortfalls. Governments that relied on tax revenue from inflated asset prices confront widening deficits. What feels like collapse is in reality the removal of an artificial support system that had masked structural weakness for years. This is why the current moment feels so unsettling. The global economy is not merely slowing down, it is detoxing from the largest debt binge in modern history. And like any detox, the withdrawal is painful, unpredictable, and impossible to reverse without consequences.
As the effects of higher interest rates ripple through the system, the illusion of stability begins to unravel at every level. Central banks now find themselves trapped in a position of their own making. If they lower rates again to rescue failing companies and overstretched borrowers, inflation threatens to roar back, eroding purchasing power and destroying what remains of middle-class savings. If they keep rates elevated to restore credibility and contain prices, a wave of defaults becomes inevitable. There is no clean exit. Every possible choice carries systemic damage, and the margin for error has vanished. The debt accumulated during the era of free money did not stay confined to corporations. It seeped into every corner of the economy. Governments expanded spending under the assumption that borrowing would remain cheap forever. Households took on larger mortgages, student loans, and consumer debt, believing low rates were permanent. Financial institutions built entire business models around leverage. When interest rates normalized, the cost of servicing this debt exploded, exposing how fragile the structure had become. One of the most dangerous pressure points is commercial real estate in the United States and Europe. The pandemic permanently altered work patterns, but the financial system never adjusted its assumptions. Office towers were valued as if pre-2020 occupancy would return indefinitely. In reality, remote and hybrid work hollowed out demand. Vacancy rates climbed to historic levels, yet on paper, many of these buildings retained their old valuations. Banks allowed this illusion to persist through a practice often called extend and pretend, rolling over loans rather than recognizing losses. This strategy bought time, but it did not solve the problem. That time is now running out. In 2025 and 2026, a massive volume of commercial real estate loans will mature. When owners attempt to refinance, they are confronted with a harsh reality. The buildings are worth far less than the debt attached to them. Lenders demand additional capital to cover the gap. Many owners simply cannot pay. As a result, defaults accelerate and keys are quietly handed back to banks. This process threatens the very institutions that enabled it. The risk is not concentrated in the largest global banks, which are more diversified and better capitalized. It is concentrated in regional and mid-sized banks that hold a disproportionate share of commercial real estate. These banks are deeply embedded in local economies. When their balance sheets crack, the damage spreads quickly. Small businesses lose access to credit. Hiring freezes turn into layoffs. Unemployment rises, reducing consumer spending and feeding back into further defaults. What begins as a real estate problem becomes a full-scale economic contraction. This dynamic is unfolding at the same time as another major pillar of the global economy weakens. For decades, China acted as the engine of worldwide growth. Its rapid urbanization and industrial expansion consumed vast quantities of raw materials and fueled global trade. But that growth was built on an unsustainable foundation. In China, real estate became the primary store of household wealth. Developers pre-sold apartments that did not yet exist, using new buyer money to service old obligations. As long as prices rose, the system appeared stable. When prices stopped rising, the entire structure collapsed inward. Developers defaulted, construction halted, millions of unfinished homes were left standing as concrete shells. Ordinary citizens saw their life savings evaporate. This triggered a balance sheet recession, where households and businesses focus on repairing their finances rather than spending or investing. Demand shrank and growth stalled. China's response has been to export its excess capacity to the rest of the world. Factories continue producing, flooding global markets with cheap goods in an attempt to maintain employment and cash flow. While this may temporarily stabilize domestic conditions, it exports deflation abroad. Manufacturers in Europe and North America struggle to compete with falling prices, further compressing margins and wages. What was once seen as a powerful economic reopening has revealed itself as a mirage. These two crises, Western commercial real estate and Chinese property, are not isolated events. They represent the simultaneous collapse of the asset classes that underpinned global growth for decades. Real estate served as collateral for loans, government revenue, and household wealth. When its value declines, the entire financial system weakens. Banks become cautious, credit tightens, investment slows. The feedback loop intensifies. At the same time, governments are in no position to mount the kind of rescue operations seen in past crises. Public debt levels are already historically high. A significant portion of government revenue is now consumed by interest payments alone. Large-scale bailouts would require either massive new borrowing or direct money creation, both of which risk destabilizing currency values. The traditional playbook of cutting rates and printing money has lost its effectiveness. This creates a dangerous interdependence between governments and banks. Banks hold large amounts of government debt as supposedly safe assets. Governments, in turn, guarantee depositors to maintain confidence. If banks fail, government finances deteriorate. If government finances deteriorate, the value of the bonds banks hold declines. Each props up the other, and a shock to one quickly spreads to the other. The system becomes a closed loop with no external support. As trust erodes, the foundation of modern finance begins to crack. Financial systems are built on confidence. Depositors believe their money is safe. Investors believe assets will retain value. When these beliefs weaken, behavior changes rapidly. People hoard liquidity, businesses delay investment, markets become volatile and unpredictable. What looks like irrational fear is often a rational response to uncertainty. The global economy is not collapsing because of a single trigger. It is collapsing because the collateral that supports it is losing value. At the same time, the cost of money has risen. The combination is lethal. Asset prices fall, while debt obligations remain fixed. Balance sheets shrink. Losses compound. The adjustment process is slow, grinding, and politically destabilizing. As this pressure builds, authorities face an uncomfortable reality. They cannot allow the system to unwind freely without risking widespread social unrest. Yet they cannot restore the old conditions without triggering inflation and currency debasement. This impasse sets the stage for a different kind of response, one that shifts the burden of adjustment away from institutions onto individuals. The next phase will not be defined by sudden collapse, but gradual constraint. Controls will be framed as stability measures. Emergency tools will become permanent features. Financial freedom will be traded for the promise of security. The system will survive, but it will be transformed in ways that fundamentally alter how money functions and how wealth is preserved. As the crisis deepens, policymakers are forced to confront a reality they have spent years avoiding. The scale of global debt is now so vast that it cannot be repaid in honest terms. More than $300 trillion in obligations sit across governments, corporations, and households. There is no realistic combination of growth, taxation, or austerity that can extinguish it. Default on a large scale would shatter the financial system overnight, yet repayment is mathematically impossible. That leaves only one path: liquidation through stealth. Debt must be eroded slowly and quietly while preventing capital from escaping the system. This is where the final stage of the response begins. When economic tools fail, political tools take their place. The transition will not look like a dramatic collapse or a sudden moment of chaos. Instead, it will resemble a tightening net. Restrictions will be introduced gradually, always justified as temporary measures designed to protect stability. Each step will feel reasonable in isolation. Together, they will fundamentally change the nature of money and ownership. Central bank digital currencies emerge as the centerpiece of this shift. For years, they were marketed as harmless upgrades, faster payments, cleaner settlement systems, modern replacements for outdated banking rails. In reality, they represent a structural transformation of money itself. A digital currency issued directly by a central bank is not merely a digital version of cash. It is a programmable financial instrument embedded within a centralized ledger. In the existing system, physical cash provides an escape valve. If confidence in banks weakens, individuals can withdraw money and hold it outside the system. That option disciplines financial institutions and limits the power of authorities. A fully digital currency removes that option entirely. Funds never leave the system, they only move within it. Every transaction is visible, traceable, and subject to rules that can be changed without consent. With programmable money, policy shifts from influencing behavior to enforcing it. If economic activity slows, negative interest rates can be imposed directly on balances, causing savings to decay over time. Spending is no longer encouraged through incentives, but compelled through design. If shortages emerge, consumption can be rationed digitally, limiting how much of certain goods can be purchased. Money ceases to be a neutral store of value and becomes a tool of behavioral management. The groundwork for this transformation is already visible. Across many countries, limits on cash transactions are being introduced under the banner of fighting crime and tax evasion. Individuals and organizations are quietly excluded from the banking system for reputational reasons, often without due process. These developments are not isolated policies. They are components of an infrastructure designed to exert control when traditional mechanisms fail. As trust in institutions erodes, the justification for these measures becomes easier. A banking crisis triggered by commercial real estate defaults or sovereign debt stress creates the perfect pretext. Rather than bailing out banks directly with taxpayer money, which is politically unpopular, authorities can restructure the system itself. Deposits can be migrated onto centralized digital ledgers, framed as a safety upgrade. The public is told their money is protected. In reality, it is contained. This shift fundamentally alters the psychology of wealth. For decades, the objective of investing was maximizing return. Risk was rewarded, leverage amplified gains. In the new environment, the priority becomes preservation. The question is no longer how much can be earned, but whether assets can be retained at all. This change is already reflected in the behavior of large institutional players. Wealthy individuals, sovereign funds, and central banks are repositioning away from financial assets that depend on stable monetary policy. Instead, they are accumulating tangible resources. Farmland, energy infrastructure, precious metals, and strategic commodities attract growing interest because they exist outside the digital abstraction of finance. These assets cannot be created with keystrokes. They cannot be erased by policy adjustments. Their value is rooted in physical utility and scarcity. Meanwhile, the financialized wealth held by the middle class remains exposed. Retirement accounts, heavily weighted toward overvalued equities and low-yield bonds, depend on conditions that no longer exist. As inflation outpaces returns and asset prices adjust downward, purchasing power erodes. This erosion does not appear as a single dramatic loss. It unfolds gradually, year after year, disguised by nominal gains that fail to keep up with rising costs. The result is a slow decline in living standards, particularly in developed economies that benefited most from cheap debt and globalized supply chains. The abundance of the past decades was not the product of sustainable productivity alone. It was amplified by leverage, financial engineering, and access to inexpensive imports. As these forces reverse, expectations collide with reality. Trust becomes the ultimate casualty. Trust in banks, in currencies, and in the implicit agreement between citizens and institutions weakens. When that trust breaks, economic activity fragments. Parallel systems emerge. Official channels continue to operate, monitored and regulated, while informal networks grow alongside them. Barter, alternative stores of value, and off-ledger transactions gain relevance not out of ideology but necessity. History shows that such transitions are rarely smooth. They are periods of experimentation, tension, and adjustment. Authorities attempt to maintain control while populations seek stability. The balance between the two defines the character of the era. What distinguishes the current moment is the technological capacity for surveillance and enforcement. Never before has monetary control been so precise or so scalable. The maturity wall approaching in the mid-2020s acts as the catalyst. As debt rolls over at higher rates, losses surface across balance sheets. Banking stress intensifies. Policy responses accelerate. Each measure builds upon the last, narrowing options for both institutions and individuals. Preparation windows close quietly, not announced but felt. This is not a prediction of immediate collapse, but of transformation under pressure. Systems adapt to survive, even if that survival comes at a cost. The form of money, the nature of ownership, and the meaning of financial security are all being redefined. Those changes do not arrive overnight. They arrive through policy updates, emergency rules, and temporary solutions that become permanent. When the adjustment is complete, the world will still function. Transactions will still occur, markets will still exist, but the rules governing them will be different. Wealth will be measured not only by quantity, but by control. Assets that can be frozen, taxed, or diluted at will be perceived differently from those that cannot. The question facing individuals is not whether this transition will happen, but how prepared they are to navigate it. Where wealth is stored matters. How dependent it is on centralized systems matters. In an environment where policy replaces markets as the primary driver, resilience becomes more valuable than optimization. The music does not stop with a crash. It fades, and by the time silence is noticed, the exits are harder to reach.